This video, we are going to talk about EVA. The problem is that for many years, managers would evaluate the result of the business based on net profit, operating profit, earnings before interest, tax, depreciation, and amortization, and so on. However, the problem is that all those financial metrics actually motivate managers to have dysfunctional behavior. Dysfunctional behavior means that they are trying to achieve the KPIs. They are achieving the KPIs, but that is done with the detriment to the success of the company. Why? Well, to get net profit result as required to receive the bonus, managers may be willing to postpone training, marketing, research expenses. However, we understand that this is something that is needed for the long-term success of the company. And if, for example, you have an IT company and you do not send your software developers on training, quite often the technology that they are using becomes obsolete very fast, and your desire to get this net profit metric will actually mean that the company is not able to stay competitive the following year or in 2 years. And EVA, it's actually trademarked because this is the proprietary name. EVA was developed to find this concern. So we quite often in the exam, you will get a metric such as return on capital employed in your first question, and you need to know what to write as to why return on capital employed is a dysfunctional metric. It's not a very good measure of shareholders' wealth. So my students get this file with this this pre-written examples so that they could take that knowledge and just paste that, memorize that, and paste that in the exam. And they do not have to spend their brain activity on doing that. Okay, but in this very video, let's go to the calculation of EVA, how it is done. Well, EVA takes notional operating profit after tax, that is NOPAT. This is notional, not nominal. And from that, we are going to subtract adjusted capital employed at the start of the year, multiplied by weighted average capital employed. And now let's talk about each and every part in detail and separately. Why? Because in this very exam, you will get just half of your mark for calculating EVA. And at least half of the mark will be given to you for discussing the adjustments, the assumptions, the benefits, the drawbacks. So not only you need to know what to add and what to deduct, you need to be able to explain why we're doing that. Okay, so there are going to be 3 major adjustments. First, we will need to convert P&L items to cash. This means that we will need to take away our bad debt provision, for example. Why? Well, because investors are mostly concerned with cash. Why? Well, it is kind of expected that a company is profitable. But sometimes companies may not have cash available to pay dividends. And even though companies are profitable, the dividend payout ratio is not as hoped. So we will need cash to pay dividends. We will need cash to have new investments. And also we will need to do that to get away from accounting policies and estimations. Well, because actually this bad debt allowance, even though it is governed by IFRS, that is very strict, still this is something that is subjective, together with, let's say, the obsolescence provision for inventory. So we will need to convert P&L to cash because cash is more objective. Another thing that we need to do is to capitalize marketing, HR, and research and development costs and training costs. Why? Because these are the costs that are going to provide long-term value for the company. So these are like intangible assets. And even though they cannot be recognized by IS 38, which is the IFRS standard that governs that, still, as a company, we know better. We know better that we are going to get benefit from this marketing, get benefit from this training expenditure in the forthcoming years. So we are going to capitalize that, and then we will depreciate it based on the real consumption of those costs. We will exclude unusual items such as, let's say, restructuring cost. Why? Because we want to show the users of the report, of this management report, the sustainability of this EVA. So the sustainable value, meaning that this trick can be repeated in future. So to calculate notional operating profit after tax, we will take operating profit, and it's going to be put here controllable, because sometimes we want to calculate EVA for department, so it's not going to be groups-wide operating profit, only the one that relates to this very department that they can control. Then we will need to add back accounting depreciation. Why? Well, because this is an expense that is P&L expense. It's not cash expense. So we will get it back. However, we will charge economic depreciation because we want to reflect the pattern of the real usage of the assets. We will add back increase in provisions because this is P&L, and we will deduct a decrease in provision because, again, it's just P&L item, it's not cash. We will capitalize advertising, research and development, and employee training costs because we need to capitalize those long-term value-creating expenditures, and then we are going to amortize them based on the consumption. Well, we have here that need to capitalize to add back operating lease payments, and then we would need to depreciate this operating lease payments, and you can say, okay, but IFRS 16 now says that those who lease something, who take this leased asset, they do not have operating lease or finance lease. There is just a single way the accounting is made for the company that leases this building or this machinery. Yes, that is right, but we need to take into account that these principles of management accounting apply not only to those countries that use IFRS, but to any country in the world. And if that country has operating lease payments, if that country accounts for lease as it pays, does not apply IFRS 16, well, we need to acknowledge that. So yes, there will be deviations between IFRS and the accounting as it is perceived by management accounting here. And we will need to add back non-cash expenses, again, because we care about cash, because cash is required to pay dividends and finance investments. Another very important adjustment is that we need to deduct tax paid, and we will need to account for this lost tax relief on interest. What does it mean? Well, if you look at the EVA formula, you will see that we use weighted average cost of capital. And if you remember your financial management studies, you will remember that that interest is going to multiply by 1 minus tax. So we will take this tax relief there, and we do not want to account for this tax relief both in our notional operating profit and weighted average cost of capital. As such, we need to take away this tax relief on interest in this example. And that is going to be tricky. and then gives us notional operating profit after tax. And as for capital employed, we need to clearly state that capital employed is taken at the start of the year. And if we take accounting capital employed, so the one that we take from financial statements by taking share capital, share premium, retained earnings, for example, then we, and long-term debt, we will need to add adjustments for all notional operating profit after tax for previous years. Not for the current year, but those that have been accumulated before the start of the year. And we take that only at the start of the year. And as for weighted average capital cost of capital, it is calculated like the usual formula. And that is it. That is how we calculate EVA. And when you look at the scenario, you will need to be able to read these tricky pieces of scenario and understand what it means and be able to calculate EVA if operating profit is given, if net profit is given, if gross profit margin is given, and so on. So that's why I have this file that takes different situations, different types of scenarios, along with copy paste from real life exams from past years, and we will practice that. So contact me for practice so that this very topic that is tested quite often is super familiar to you.